Good day, students. My name is Ruth Egunjobi, the tutor for Economics EC20S2. I'll be taking you through the course contents as well as a guide on the tutorial letter which you're going to get. My email address is on the screen, and let's go through the course contents. The first thing I want us to do today is I want to remind you of the learning outcomes. The learning outcomes for this course, basically in a nutshell, we're going to explain customers' reaction to changes in price, describe the impact of the government policy on the economy, and state or estimate the national outcome using both approaches. Now, the both approaches I'm talking about are the income method as well as the expenditure method. The recommended textbooks, the Principles of Economics, the 7th edition, 2014, as well as Sloman and John's Essentials of Economics, 6th edition, 2013. Now, a quick guide into the tutorial. You need to include referencing in answering your questions. In other words, every source you took information from, you need to include it in your write-up. You need to write properly and answer the questions as required, as I'm going to show you at the end, and use diagrams when needed, when necessary. Let's quickly have an overview of the course outline once again. The first point is the introduction. What is the introduction all about? The introduction into the concept matter of economics. Basically, we're going to define the subject matter of economics. We're going to look into the concepts of wants, needs, and opportunity costs. We're going to look into the factors of production, such as land, labor, capital, and entrepreneurship. Economic systems, that's the mixed, the common, and the market. We're also going to look at the production possibility curve. And finally, for the introduction, we're going to see the basic difference between microeconomics and macroeconomics, because economics is a very wide field, which is split into two broad aspects, the microeconomics and the macro. The second thing on the course outline is the theory of demand and supply, which we're going to go into shortly. The third point is the theory of consumer behavior. The fourth one, the theory of production and costs. The fifth point on this course outline, market structures. The sixth point, macroeconomic issues and measurement. The seventh, fiscal and monetary policy. 8 is money. 9, international trade. And finally, exchange rate mechanisms. So I'm going to go through the course outline, then come back to talk about the tutorial later. By the way of introduction, what is economics? Just to guide you into your reading as you read more about this course from the recommended textbooks, we should know that economics is basically a social science which is concerned basically with the production, distribution, and consumption of goods and services. In other words, it attempts to explain how wealth is created and distributed in communities. That is, how people allocate resources that are scarce, which have so many alternative uses. Wants. What is want in economics? Goods or services that are not necessary, but that we desire or wish for. For example, one needs clothes, but one may not need designer clothes. Needs, on the other hand, are goods or services that are required. This could include the needs of food, clothing, and shelter. So economics is basically between wants and needs, resources that are scarce, and we need to know the difference between what is a need and what is a want. Another concept we need to look into is the concept of opportunity costs. Opportunity costs can be defined as the benefits that a person would have received but gave up in order to take another course of action. Stated differently, an opportunity cost represents an alternative given up when a decision is made. Since the resources are very scarce, then we come across the concept of opportunity cost, the other alternative which a person would make due to the scarcity of resources. Another concept by the way of introduction is the factors of production. The factor of production is an economic term that describes the inputs that are used in the production of goods or services in order to make an economic profit. Now, the factors of production, as we know, these include land, labor, capital, and entrepreneurship. Economic systems, still by the way of introduction. An economic system refers to the means by which countries and governments distribute resources and trade goods and services. That is an economic system. And economic systems are basically three. We can have the free market economy, whereby there is no restriction. We can have the command economic system, such as communism and socialism. We can have the mixed as well, whereby we have a combination of the two. Now we come to the concept of microeconomics. After looking at the broad concepts in the subject matter of economics, let's have a look at what microeconomics is all about. Microeconomics is the study of economics at an individual, group, or company level. Now, it's micro, from the word micro meaning small. Macroeconomics, on the other hand, is the study of the national economy as a whole. So micro is small, as in the little aspects of economy, which talks about the individual households, the business, and the firms. Macro, on the other hand, looks at the study of the national economy as a whole, looking at bigger issues like unemployment, inflation, balance of payments, deficits, and all that. Now, a production possibility curve, or the production possibility frontier, which is the PPF, is a curve which shows the maximum possible output combinations of two goods or services which an economy can achieve when all resources are fully and efficiently employed. Like you can see in the diagram which I have, on the x-axis we have the quantity of butter produced, on the y-axis the quantity of guns produced. The idea here is that an economy given two resources, in this case butter or guns, what is the optimal level of production? Points A are points that are inside the curve. We call those points unattainable. Underutilized. Points C, D, and B are the possible combinations we can have. If you have less butter produced, you have more guns produced. If you have more guns produced, you have less butter produced, as you can see by the points B, D, and C. Point X is outside the curve, and points that are at that level shows that the combinations are not attainable. So when we're looking at the PPF, we're looking at an economy given two resources. How can we efficiently maximize those two resources? Now let's go to the first point in the introduction. That's all I've said is by the way of introduction. Let's now go into the theory of demand and supply. Let's start with the microeconomic aspect of the course. Like I said earlier, it's split into two, the micro and the macro. The first point in the micro aspect is the theory of demand and supply. What is the theory of demand and supply? In a nutshell, it basically talks about the relationship between demand and price. That's the theory of demand. And the theory of supply is a relationship between price and supply. Now, the theory of demand shows a negative relationship or an inverse relationship between demand and price. And what do I mean by an inverse relationship? Here we have an XY plane, quantity and price. This is the inverse relationship. This is the demand curve. An increase in price leads to a decrease in quantity demanded. That is the relationship between demand and price. And that is the theory of demand. It basically says when the price of a commodity increases, the quantity demanded reduces. And the theory of supply, which is the relationship between price and quantity supplied, is a reverse of this. Also, the relationship between quantity and price, the supply curve looks like that. An increase in price leads to an increase in quantity supplied. A positive relationship. Now, what are the determinants of demand and supply? We have a difference here. We have the determinants of demand and supply, and we have the determinants of quantity demanded and quantity supplied. What are the determinants of demand and supply? In other words, what determines how much a consumer demands or how much a consumer supplies? And these are things like income and taste. On the other hand, the determinants of quantity demanded or quantity supplied is basically a function of price. So what quantity we demand is a function of price. What quantity we supply is a function of price. But what makes us demand a commodity could be things like other factors like income or taste or things like that. Now, the demand and supply curves, which I drew a while ago, we have movements along these curves. A movement along the demand or the supply curve is determined by price. For example, this is the supply curve. This is point A, and that is point B. The movement from A to B is determined by changes in price. Also for the demand curve, that is quantity, this is price. The movement from A to B is also determined by changes in price. But on the other hand, we have movement along the demand and the supply curves. Like you can see in this diagram on the screen, on the left we see demand and supply combined, price and quantity. Q star is equilibrium quantity, P star is equilibrium price. That is when demand is equal to supply. Both curves in one diagram. On the right hand, we can see what I call the increase in demand, a shift in the demand curve. You see D1 is the initial demand curve, and D2 is a new demand curve. What causes a shift in the demand curve? Things like taste and income, other things not related to price. This diagram on the left-hand side illustrates an increase in supply. S1 is the initial supply curve. S2 is a new supply curve. And you can see the effect it has on the price and quantity as well. When there's an increase in supply, we see that price falls from P1 to P2, and the quantity supplied increases from Q1 to Q2. On the right-hand side, you can see the four graphs combined. Increase in demand from D1 to D2, an increase in supply from S1 to S2. And you can see the effect it has on quantity. So this is a theory of demand and supply. Once again, we look at the theory of demand and supply, which is the relationship between price and quantity demanded or quantity supplied. The relationship between demand and quantity and price. And the equilibrium conditions, what happens when there's a change in those initial conditions. Still on the theory of demand and supply, we come across the concept of elasticity. And elasticity is a measure of the responsiveness of demand or supply to changes in price. In other words, how does demand react to changes in price? In other words, if you change the price of a commodity, how do consumers react to that change in price? And this change could be elastic, it could be inelastic, it could be unitary. So these are things you need to take note of when you're doing your readings. Equilibrium conditions, which are the graphical things I showed in the previous slide. Equilibrium, price and quantity, as well as shifts in the equilibrium conditions, are things we should look at in the theory of demand and supply. Secondly, we go to the theory of consumer behavior, and we come across the concept of utility. Utility is the satisfaction derived from the consumption of a good or a service. And the types of utility we have could be marginal, could be total, could be average utility. And we come across the law of diminishing marginal utility, as well as the indifference curve and the indifference map. Okay, let me start with the indifference curve. What is an indifference curve? An indifference curve is a curve which shows the combination of two goods whereby a consumer is indifferent. An indifference map is a combination of indifference curves. For instance, this is an indifference curve. And if you have a lot of them, this is indifference curve 1, indifference curve 2, indifference curve 3. So this curve shows the combination of two goods, good A and good B, whereby a consumer is indifferent. Along this curve, the consumer is indifferent. In other words, this level provides a level of satisfaction from the consumption of two goods or two services. So the ID curve, the indifference curve, is a locus of various points showing different combinations of two goods providing equal utility or satisfaction to the consumer. The law of diminishing marginal utility. This law states that as a consumer consumes more and more units of a specific commodity, the utility from successive units goes on diminishing. For instance, if you're thirsty, you take a bottle of Coke, the utility derived initially is very high, but as you keep on consuming more cups of Coke, then utility or the satisfaction you derive from successive cups you consume goes on diminishing. And that is the law of diminishing marginal utility. The other concept is the marginal rate of substitution. Now we're looking at two goods here, good A and good B. And this is the rate at which a consumer can give up some amount of one good in exchange for another good while remaining on the same level of utility. Between good A and B, the rate at which you give up A to get more of B is a marginal rate of substitution. For instance, at this point, you have this quantity and that quantity of B. But if I give up more of A and come down here, then I'm going to get more units of B. And that is a marginal rate of substitution, the rate at which we give up A in order to get more of B, in order to remain on the same level of satisfaction. Graphically, you can see the first diagram on the left, the total utility. You can see the quantity of chocolate bars, for instance, and the total utility. The more bars you consume, the more utility or satisfaction you derive, until we get to the peak there. And after the peak at 0.5, the utility begins to fall, which is the point at which you say diminishing returns has set in. The satisfaction you receive is not as much, it's actually diminishing, it's not as much as you got before. On the right, we have the marginal utility. You can see the utility is actually falling till it gets to negative. And the other diagram there is the indifference curve between apples and bananas, like I tried to illustrate on the paper. Now we go to the third concept, the theory of production and costs. Still on the microeconomic aspect of the course outline. What is the theory of production? Production basically talks about transforming inputs into outputs. That is production. A firm takes inputs and transforms it into outputs. And production, we're going to talk about that. We need to look at the total product, the average product, the marginal product, both of labor and capital. In the production theory, we have two components to production: labor and capital. And we need to look at these two, the total product of labor as well as the total product of capital, the average and marginal product of labor and capital. Production on one hand, the other side is costs. What are costs? Costs involved in the production process. In other words, in order to produce an output from inputs, we need some costs. Costs are involved. And these costs could be average or total, marginal or fixed. At this point, you need to look into how to calculate, basically. How do we calculate total cost? How do we calculate total product? How do we calculate marginal and average cost as well as product, as well as the graphs that go along with that? Before we go into the tables, let's look at the long run and the short run. In the theory of production, there is what we call the long run. And in the long run, we're looking at a period of time whereby all inputs are elastic. In other words, they're all variable. We can change inputs anyhow as we like in order to achieve an output. On the other hand, the short run refers to the production period when the supply of inputs are fixed. In other words, it's very inelastic. That is the short run and the long run. Now, the total product of labor, which is the production function, Q, is a function of K and L. K stands for capital and L stands for labor. So the output we have, which is Q, is a function of how we work with capital and how we work with labor. And the output depends on capital and labor. And MPL, which is the marginal product of labor, is a change in Q divided by the change in L. In other words, holding labor constant. Graphically, it looks like this. The first graph is the total product. On the horizontal axis, we have labor. On the vertical axis, we have TP. And you can see the TP curve. As we increase labor, you can see the total product increases, gets to a maximum and begins to fall. I'm going to explain why it's going to fall. And below that, you see the relationship between labor and product as well, which is the marginal product of labor. Let's talk about and why it falls, why TP diminishes is here, the law of diminishing marginal return or the law of diminishing marginal productivity. Why does the TP curve fall? As one output in the production of a commodity is increased, while all other inputs are held constant or fixed, a point will eventually be reached at which additions of inputs yield progressively smaller or diminishing increases in output. Back to this diagram. As we increase labor, from the first worker to the second to the third, output is increasing. Beyond the eighth or seventh worker, the output begins to diminish. And that is the law of diminishing marginal utility. Holding other things constant as you increase output of one production component, total product is going to increase. After that, it's going to diminish. Returns to scale. Returns to scale basically refers to the rate by which output changes if all inputs are changed by the same factor. We now move on to market structures. Let me give you an overview of market structures. There are 4 types of market structures we're going to consider in this course, and I've put it in a table. The perfect market, perfect competition. We have the monopolistic competition, oligopoly, and monopoly. And in this table, you can see what happens in the number of firms, freedom of entry, the nature of the product, implication of the demand curve, average size of the firm, consumer demand, profit, and government intervention. For instance, let's look at the perfect market. How many firms in a perfectly competitive market? There's so many firms in a perfect market. Freedom of entry, no restrictions. Anybody can set up that business anywhere. The nature of the product is homogeneous. I mean, it's common. The demand curve is horizontal. And what do we mean by a horizontal demand curve? It means at that price, your firm can sell unlimited quantity at that particular price because it's a perfect market. The firm is basically small, consumer demand is low, and this table is a snapshot of market structures, the kinds of market structures we can have in an economy. And what is important also is how is profit maximized in these markets graphically. This is something that you can read up in the text, as in when is a monopolist making a loss, when is a monopolist making a profit, when is a perfect market in making profit, or when is there loss in a perfect market. These you should do graphically. Okay, let's quickly go to the macroeconomic aspect of the course outline. We're done with the micro, now to the macro. Macro looks at the big things. And the first thing on the course outline is the macroeconomic issues and measurement. We're going to look at the macroeconomic concepts. The first one are the GDP and the GNP. We're going to look at national income accounting, that is computation of the GDP and the GNP using the two approaches. And this course looks at the income approach as well as the expenditure approach. Let's start with the expenditure approach. As you can see, GDP is equals to C plus I plus G plus X minus M. What does C stand for? C stands for consumption. I stands for investment. G stands for government expenditure, plus the difference between exports and imports. X stands for exports, M stands for imports, X minus M. So if you're asked to derive the GDP using the expenditure approach, we're basically going to add the consumption, the investment, the government expenditure, plus the net exports. And that's going to give us the GDP expenditure approach. Income approach, which is NI, is going to be the sum of W, which is wages, the labor income, R, which is the rental income, I, which is the interest income, PR, which is the profit. In other words, all incomes are added, whether from labor, which is wages, or from the rental income, or from interest, which is I, or from profit. That is GDP using the income approach or the expenditure approach. What is GNP, the gross national product? Is C plus I plus G plus X minus M plus Z. Now, what is Z? As you can see on the screen, the net income earned by domestic residents from overseas investments. Net income earned by foreign residents from domestic investments. So when we take the GDP basically, and we add the net income from abroad, that is what it's going to give us the GNP. The second point to look at in the macroeconomic aspect is government macroeconomic policy. And this talks about how does the government control the workings of the economy. Usually implemented through two sets of tools. We have the fiscal policy and the monetary policy. The government uses the fiscal policy and the monetary policy to stabilize the economy, which can mean boosting the economy to the level of GDP consistent with full employment. Two tools that the government can use, which forms the government's macroeconomic policy, fiscal policy or monetary policy. Let's start with fiscal policy. Fiscal policy is the means by which a government adjusts its spending levels, that is government expenditure, and tax rates to control a country's economy. Fiscal policy has two elements: taxation and government expenditure. The government can use government expenditure or taxation basically to control the economy. And that is fiscal policy in a nutshell. Monetary policy, on the other hand, is done through the central bank, in other words, the Bank of Namibia. How it can influence the nation's money supply. In other words, the monetary policy is carried out through the central bank to influence money supply. And how do they do this? They do this by reserve requirements by the banks, open market operations, and the discount rate. So monetary policy is through the central bank to influence money supply. Let's quickly have a look at how these tools or instruments can be used to influence the economy. In other words, money supply. Let's start with the fiscal policy. The fiscal policy, remember, the tools of fiscal policy are government expenditure or taxation. If there's an increase in taxation, if the government increases taxation, what does this do? It basically decreases money supply. And if the government decreases taxation, this increases money supply. You can see how fiscal policy works. Government expenditure, the other tool of fiscal policy. If the government increases government expenditure, this is going to if the government increases government expenditure, this is going to increase money supply in the economy. And if the government decreases government expenditure, this is also going to decrease money supply in the economy. Let's look at the bank rates. The bank rates, the bank rate is for the monetary policy through the central bank to the commercial banks. The bank rate is the rate which is mandated by the commercial banks to keep of the demand deposits they receive. Now, if there is an increase in this bank rate, it's going to decrease money supply. On the other hand, if there's a decrease in the bank rate, it increases money supply. And the reserve ratio, if there's an increase in the reserve ratio, the reserve ratio is the mandated quantity of demand deposits the commercial banks are required by the central bank to keep within the bank. So if there's an increase in the reserve ratio, it decreases money supply. On the other hand, if there's a decrease in the reserve ratio, it increases money supply. So this is the government macroeconomic policy, how the government uses fiscal and monetary policies to affect the workings of the economy in terms of money supply. Now we go to money. Money is still under the macro. Money is defined, we're going to look at the definition, the characteristics, as well as the functions of money. These are the three things we need to look at. What is money? We can see here that it must be an acceptable medium of exchange. It must be a legal tender for the payment or resettlement of debt. It must be a standard of value. It must be a unit of account. It must be a store of value. Also, you can read through the history and the evolution of money. That's the trade by barter. So that's the definition, the characteristics, and the functions of money. Now we look at inflation, which is the fourth part in the macroeconomic side. Inflation is defined as a rise in the general price level of goods and services in an economy over a period of time. An increase in the general price level, a rise in the general price level of goods and services. And what causes inflation? In theory, we're going to look at the two: demand pull or cost push. Demand pull inflation. This is when aggregate demand in an economy outpaces aggregate supply. When aggregate demand is more than aggregate supply, it leads to inflation. It causes the rise in the general price level. Cost push is the other cause of inflation. This is inflation caused by increase in the prices of inputs. Now, inputs like labor, raw material, if there's an increase in the price of inputs, this translates to inflation, which we call cost push. It's derived from increases in the costs of raw material for production processes. So those are the two causes of inflation: cost push or demand pull. Now, what are the effects of inflation? It has effects on so many things. What is the effect on investment? What is the effect on interest rate? What is the effect on the exchange rate? What is the effect on unemployment? And so on. So this also you should read up, as in the effects of inflation on the economy, which are negative. Now we look at controlling inflation. How does the government control inflation? Also, we're going to use the two tools: monetary measures such as open market operations, the bank rate policy, and the reserve ratio requirements, or the fiscal policy tools, which are the government expenditure and taxation. Now we move to international trade. International trade is also part of the course outline. International trade is the exchange of capital, goods, and services across international borders or territories. The exchange of goods and services among nations of the world. That is what international trade is all about. And we come to why nations trade. Why do countries trade? In the theory, there are two main reasons why countries trade. The first one is the comparative cost advantage. The second one is the absolute cost advantage. What is the comparative cost advantage? Differences in factor endowments or technological progress. When there's a difference in the way a country is endowed in technology or or factors of production and all that, then in comparison with other countries, that country has more resources in order to trade with other countries that do not have those mineral resources or technological progress, and that leads to trade. On the other hand, absolute cost advantage refers to the ability of a business to produce more, sell more of a good or services better than competitors using the same amount of resources. So if country A can sell more than country B with the same amount of resources, then country A has an absolute cost advantage over country B. On the other hand, the comparative cost advantage is if country A is well endowed in mineral resources and technological know-how, whereby country B doesn't have so much resources or so much technology, then country A has a comparative cost advantage over country B, and as such is going to engage in trade with the other country that doesn't have those advantages. That is now let's quickly go through the tutorial letter that you have received for 2018. We come across concepts that like list and explain. You need to list first and explain what you have listed. Differentiate between. You need to define the two concepts and talk about the differences between them. Explain the difference between. Explain the difference you understand between the two concepts in question. List and explain. Calculate is another one. In other words, show your workings, show how you derived those answers, especially on the elasticity questions. Compare and contrast, like the market structures, the table I gave you earlier. Contrast between perfect market and oligopoly. You contrast, you say the differences between them, you compare them, you contrast them. And don't forget to use diagrams to illustrate your answers. The theory is one part, but you have to illustrate what you have written also graphically. And finally, define. Don't forget to use keywords in your definitions. As you read the text, keywords are very important. That is the end of this session, and I wish you all the best in the course. Thank you.